Are you financially driving blind, or do you actually have a detailed roadmap for the coming year?
That's the big question, isn't it?
It is. I think for most of us, when we look ahead at just the sheer volume of data, market movements, shifts in Federal Reserve policy, new tax laws, we don't feel empowered. We feel overwhelmed.
Completely. It's like staring into a financial fog bank and just, hoping you stumble onto the right path.
Exactly.
And that feeling is precisely why financial momentum stalls. I mean, information overload leads directly to inertia, and inertia is really the enemy of building wealth.
But that's our mission today.
That's it. Our mission in this deep dive is to transform those huge, abstract economic forecasts and all those detailed government updates into 6 simple, concrete activities. We're giving you the blueprint for your 2026 financial game plan.
And we've been poring over a fantastic stack of sources for this. That includes foundational personal finance strategies, but also these forward-looking institutional insights from reports covering the market outlook, the latest 2026 forecasts from Realtor.com on housing, and this is the big one. The official 2026 tax and contribution limits that were just released by the IRS.
And 2026 is a particularly crucial year for this kind of proactive planning because the economic context is shifting in a pretty significant way.
Yeah.
I mean, for a while now, the global economy has been described as K-shaped.
Okay, let's unpack this for everyone listening. That K-shaped economy, that meant that, the tech giants, certain blue chip companies, and the wealthiest investors, they were just soaring up that upper arm of the K.
Right, while at the same time.
While everyone else, smaller businesses, wage earners, a lot of traditional sectors, were lagging, struggling down the lower arm of that K.
Exactly. And the forecast for 2026 suggests we are transitioning away from that K-shape towards a broader U-shaped recovery.
A U-turn.
A U-turn, exactly. It implies that the gains are finally broadening out beyond that really narrow leadership. And what's driving this optimistic outlook, well, we see several pretty powerful structural tailwinds working in the background.
Okay. What are those tailwinds? I know everyone wants to know what forces are actually pushing the economy forward.
Well, firstly, the continuing massive adoption of artificial intelligence. That's expected to drive much, much higher productivity growth across multiple industries, not just in big tech anymore.
So it's finally filtering down?
It's filtering down. Secondly, we have substantial fiscal policy support. This includes corporate tax changes from recent legislation, the OBBBA, which are really kicking in, boosting corporate earnings and encouraging capital expenditure across the economy.
Which, historically, that tends to flow down to benefit consumers and workers, right?
That's the historical model, yes. It creates jobs, it supports wages.
And what about the Federal Reserve? I mean, historically, their interest rate decisions pretty much dictate our entire financial world.
They do. The prevailing institutional view suggests a pivot away from the really aggressive easing expectations the market had been holding. So they anticipate the Fed will move from any, residual cutting posture in 2025 to more of a holding pattern in 2026.
And why is that? Why the change?
Because of an expectation of stronger growth coupled with potentially sticky inflation. The key is stability. The policy will likely stabilize. And that stability, combined with the fiscal support and the fading of certain geopolitical tariff headwinds, makes proactive planning on your part absolutely vital.
So if the economy is stabilizing and broadening its gains...
You need a plan to be positioned to capture that growth. You can't just be a passive observer anymore.
Absolutely. So let's move past the macro landscape and focus on that personal roadmap. We've distilled those 6 essential financial activities into 3 core interlocking pillars that, when you execute them correctly, they guarantee forward momentum no matter what kind of noise the market is making.
Let's do it.
Our first pillar is the bedrock, the thing everything else rests upon. Define your financial reality. It's so simple. You cannot reach a financial destination if you don't know your starting coordinates. And this is where we introduce the first 2 activities.
Activity number 1 is often the hardest, I think, psychologically, but it's the most powerful practically. Create a personal financial statement or a PFS.
And this is not just glancing at your banking app.
No. This requires dedicating a solid hour, or what we call the statement hour, to summarize everything.
That means listing your total assets, your total debts, your actual income streams, and this part is interesting, projecting your expenses for the next 6 months. Why the emphasis on projecting expenses forward?
Because the PFS acts as your personal balance sheet. It's your comprehensive physical health evaluation. And projecting those 6 months of expenses forces you to stop focusing on your past habits and start proactively planning for your near-term liquidity needs.
So you can see what's coming.
Exactly. If you know you have a major insurance premium due in month 4 or annual taxes due in month 6, that has to factor into your cash management decisions today, not when the bill arrives.
So if I'm hearing you correctly, the goal isn't just to write the numbers down on a piece of paper, but it's to create the habit of challenging those numbers and gaining total ownership of your own data.
Precisely. And we should probably detail what goes into this. The PFS is segmented into assets and liabilities. On the asset side, we have current assets. That's your cash, checking, short-term, highly liquid investments.
The easy stuff.
The easy stuff. Then you have investment assets, stocks, bonds, retirement accounts like 401ks, IRAs. And finally, fixed assets.
The fixed assets section, this is where I think people often get lazy or maybe a little too optimistic. How do you approach valuing something like your house or, I don't know, a high-value art collection?
Honesty and defensibility are absolutely key. For real estate, you should use the most objective, defensible, current market value you can find. A recent comparable sale in your neighborhood is so much better than an automated online valuation, which often misses important nuances.
Because the tendency is to pump up the numbers to make yourself feel better.
It is. The tendency is to inflate asset values, but the PFS is for your internal planning. Inflating the value only undermines your goal setting down the road. The true power of the PFS isn't its total value today, it's its regularity. You should be doing this quarterly.
Quarterly, wow.
Yes, because lenders, for mortgages, for business financing, commercial leases, they rely heavily on this statement to assess creditworthiness. If you can't manage your own numbers on a regular basis, why should they trust you with theirs?
That's a great point. Now, for the other side of the sheet, liabilities. This is where we have to calculate the financial weight we're all carrying.
And liabilities are split into current liabilities. That's your high-interest credit card debt, outstanding utility bills, short-term personal loans, and then long-term liabilities, which are primarily your mortgage, student loans, and car loans.
And when you subtract your total liabilities from your total assets,
You arrive at your net worth. That's the magic number. Monitoring this quarterly helps you track your progress. And crucially, it helps you avoid impulsive financial decisions because every move you make has to be justified against that growing or shrinking net worth number.
that clarity, just seeing that one net worth figure, immediately leads to activity number 2, set clear financial goals. You have the map, now you need the target, the destination.
And goals must be clear, specific, and measurable. We have to move beyond, I want to save more money. That's not a goal, that's a wish.
Right.
A goal is, I will save $7,500 into my IRA by April 15th, 2026, using automated monthly transfers of $625. Or I will pay off credit card A in the next 6 months by increasing the minimum payment by $300.
That specificity is the difference between a wish and an actual plan.
It's everything.
And this is where we can connect this personal goal setting directly to that 2026 economic reality we talked about. Let's use housing again, since it's such a massive goal for so many people. The forecast for 2026 suggests a steadier, more balanced market.
It does. Realtor.com is projecting modest price appreciation, only around 2.2% year over year, which is much healthier than the crazy spikes we saw a few years ago.
A lot more manageable.
Yes. But the crucial figure for goal setting is the mortgage rate. It's forecast to average 6.3% throughout 2026. And that's not the 3% rate we all got used to a few years ago.
Not at all. So if 6.3% is the reality, how should that inform a goal-setting strategy for someone who wants to buy a house?
It means that while the market isn't surging out of control, the cost of borrowing remains very high.
Yeah.
So the goal shouldn't just be save for a house. It has to be save for a house and strategically position myself for the best available interest rate.
Okay, so what does that look like in practice?
Well, affordability is expected to improve slightly, largely because incomes are forecast to rise faster than inflation. That's pushing the typical monthly payment share of income below 30% for the first time since 2022.
That's a huge milestone.
It is a significant milestone. But to take advantage of it, your goal must incorporate getting a really strong credit score and a significant down payment, ideally 20%, to minimize the impact of that 6.3% rate.
So Pillar 1 gives you the map and the target. Now we pivot. Pillar 2 is all about protecting that journey, making sure a sudden financial shock doesn't completely derail your momentum.
And this is where people often drop the ball. They focus on offense investing, saving, but they forget about defense.
So activity number 3 is the offensive move against your liabilities. Plan to reduce debt and check credit. Once you've documented all your liabilities in the PFS, you have to decide which debt you're going to attack first.
Yes, and this is where strategic trade-offs really come into play. We are talking about increasing your financial liquidity and reducing the burden of those high monthly payments.
And what are some of those trade-offs? I know there are a couple of popular methods here.
That decision usually boils down to the classic debate, the debt snowball versus the debt avalanche. The avalanche method is, mathematically speaking, superior. You list all your debts by interest rate, and you attack the highest rate first, regardless of the balance size.
And that saves you the most money in interest over time.
It does. It's the most efficient way to pay off debt.
But the snowball method, where you attack the smallest balance first just to get a quick win, that often gets credit for providing psychological motivation, right?
Exactly. And the pitfall here is choosing the purely mathematical method, the avalanche, if you lack the behavioral discipline to stick with it for years while you're paying down, say, a huge student loan or a massive credit card debt.
So you have to be honest with yourself about your own personality.
You do. You're right. Sometimes those quick wins from the snowball method provide the necessary motivation to sustain the overall habit. You have to align the method with your personality and your discipline. If you choose avalanche, you have to be hyper-focused on it to make sure you actually capture those interest savings.
And debt management isn't just about paying it down, it's also about optimizing your capacity to borrow in the future, which is why checking your credit is so vital.
Absolutely non-negotiable. You need to pull your credit report regularly from all 3 bureaus to spot any irregularities, but also just to understand your profile.
What's a common mistake people make here?
A huge one is allowing utilization rates, that's the amount of credit you use versus the amount available, to creep up, even if you pay the balance in full every single month.
So even if I pay off my card, if I use too much of the limit during the month, it can hurt my score.
It can. A high utilization rate, say over 30%, can dramatically drop your score right before you need to access capital for, say, that 6.3% mortgage we were talking about.
So being prepared means ensuring your score is optimized months before you apply, not the week before. That readiness is a crucial part of this protective shield.
Which brings us directly to activity number 4, plan for risk, emergency funds and insurance. If activity 3 reduces the likelihood of financial stress, activity 4 protects you when that stress inevitably arrives anyway.
The emergency fund rule is a constant. We hear about it all the time. But why is it so important right now, especially considering the broader economic outlook for 2026?
Well, the rule is sound. 3 to 6 months of necessary living expenses in a highly liquid, low-risk account. A high-yield savings account is perfect. But in the context of the U-shaped recovery, where job growth may be broader but still subject to sector-specific volatility, that fund acts as a vital buffer.
It's your personal shock absorber.
It's your shock absorber. If you own a small business that really struggled during the K-shaped economy, having that fund allows you to ride out a period of slower growth without racking up high-interest current liabilities, like credit card debt.
Once that cash cushion is secured, we move to the insurance review. I know so many listeners just set it and forget it. Why is a dedicated review so essential for 2026?
Because the value of your assets has changed dramatically, largely due to the recent bout of inflation we've all experienced. Think about your property insurance.
Your homeowner's policy.
Right. If your home's market value appreciated by 20% in the last few years, or if the cost of labor and materials to rebuild it has skyrocketed, your current dwelling coverage limit might be severely inadequate.
So if your house burns down, the check you get isn't enough to actually rebuild it.
Precisely. An unforeseen event could leave you significantly underinsured, and that would wipe out years of progress towards your net worth goals. You have to confirm your coverage adequacy across health, life, and property insurance, aligning it with your current asset holdings as documented back in Activity 1.
Okay, so the foundation is set, the shield is built. Now we move to the final pillar, which is where we leverage the big economic changes and the new government limits we discussed earlier for maximum efficiency and growth.
This third pillar is so crucial because it ensures you're not just surviving, but you're actively maximizing growth by utilizing the most tax-efficient and investment-aligned strategies available to you.
Which starts with activity number 5. Plan your income tax. No surprises. The feedback we often get is that people rush to maximize deductions at the very end of the year. This move mandates a proactive approach.
Exactly right. Tax planning should be a quarterly exercise, at a minimum. You should calculate your estimated taxes early in the year, utilize deductions, and prepare in advance. This avoids that terrible situation where you're forced to make a hasty, non-strategic investment in December just to lower your tax bill.
Yeah, buying something you don't even need.
And this is where knowing the 2026 IRS updates, which, remember, apply to the returns you file in 2027, becomes extremely valuable.
Okay, here's where it gets really interesting. Let's talk about the specific adjustments for 2026 that the IRS just announced. These are foundational numbers.
The most important figure for most taxpayers is the standard deduction. It's increasing substantially. For single tax filers, it rises to $16,100.
16.1.
And for married couples filing jointly, it increases to $32,200.
That is so critical. For the vast majority of taxpayers who don't itemize, this figure determines how much of their income is immediately sheltered from federal income tax. This increase literally puts more money back into people's pockets for saving or investing.
And there's also the special adjustment for older taxpayers. Taxpayers age 65 or older can claim an additional standard deduction. It's $2,050 for singles and $450 for each spouse if married filing jointly. This provides much-needed inflation-adjusted relief.
Now let's move to the marginal rate brackets. Understanding these thresholds is absolutely essential for advanced tax planning, especially when it comes to income strategies or managing capital gains. Can you walk us through the major tiers?
Certainly. The rates scale from 10% up to 37%. For planning purposes, knowing where the mid-level brackets begin and end is vital. For example, the 12% bracket for a single filer ends at $49,525. After that, you jump to the 22% bracket.
That's a big jump.
It is. Then the 24% bracket, another significant jump, kicks in for incomes over $105,700 for singles or $211,400 for married filing jointly.
And that 24% threshold is often where high earners start getting really serious about maximizing their tax-deferred savings vehicles.
It's the trigger point.
If they can put money into a 401k and reduce their taxable income below that 24%, or the next one, 32%, the benefit is immediate and substantial.
Precisely. Then we move into the higher brackets. 32% applies for singles over $201,775, and 35% starts over $256,225. And the top marginal rate, 37%, that applies to income over $640,600 for singles, or $768,700 for married couples filing jointly.
So the takeaway here is you need to know which bracket you're firmly in, or maybe which bracket you're on the cusp of entering.
Yes. That information dictates whether certain deductions or tax loss harvesting strategies are actually worthwhile for you. This is why Activity 5, tax planning, has to happen early in the year.
And this dovetails perfectly into activity number 6. Review your investment portfolio. The macro environment we talked about, the U-shaped recovery, the AI adoption, the fiscal policy tailwinds, all of this demands active attention to your portfolio structure. If you are on autopilot, you are missing opportunities.
You have to ensure your investments remain aligned with your goals, but also with the evolving economic structure. Rebalancing is essential. The sources confirm that institutional money managers are maintaining a neutral stance on equities globally, but they are overweight on the U.S.
Okay, why the continued U.S. preference, especially if the recovery is supposedly broadening out globally?
It's because of those structural tailwinds we mentioned. The fiscal policy support, the expected monetary stability in 2026, and the global leadership position the U.S. currently holds in the AI productivity boom. This suggests sustained investment participation, but a selective one.
Now, let's address some of the complexity in these institutional reports. They use jargon like being underweight duration and favoring instruments like MBS ABS over investment-grade debt. For our listener who is well-informed but maybe not a professional bond trader, what does this actually mean?
That's a fantastic question. Let's translate that fixed income strategy. Duration is basically a measure of how sensitive a bond's price is to changes in interest rates. When rates go up, bond prices go down. And the longer the duration, the bigger that price drop is.
Okay.
So if institutional managers are underweight duration, it means they are betting that interest rates will either hold steady or potentially rise unexpectedly. They are generally avoiding long-term fixed-rate bonds because the risk of loss if rates tick up is just too high for them right now.
So they are favoring shorter-term instruments or things with floating rates to protect their capital and maximize the current yield.
Exactly. And this leads to their preference for instruments like MBS, mortgage-backed securities, and ABS, asset-backed securities. These are types of structured credit that are generally higher yielding than your standard corporate bonds.
So ABS could be backed by, what, car loans?
Car loans, credit card receivables, equipment leases, things like that. And managers prefer them over corporate investment-grade debt because, as the source notes, corporate investment-grade spreads, that's the extra yield you get for taking on the credit risk, are offering poor risk asymmetry right now.
In simple terms, poor risk asymmetry means you aren't getting paid enough of a risk premium for the chance that the company might default. The reward isn't worth the risk.
You've got it. You're taking on too much risk for too little potential reward compared to structured credit like MBS or ABS, where the default prospects appear lower and the spread is more appealing. This detailed analysis should inform the portfolio review in Activity 6. Where are you placing your fixed income allocation?
And beyond that strategic allocation, the most immediate and actionable part of Activity 6 is leveraging the increased contribution limits for 2026. This is just, it's free, tax-advantaged money on the table.
This is a direct incentive from the government to maximize your tax-advantaged savings now. For your defined contribution plans, your 401k, 403b, and 457 plans, the limit rises to a substantial $24,500.
$24,500, that's a full $1,000 increase from 2025.
It is. And you have to adjust your payroll deduction now to ensure you hit that maximum by the end of the year.
And for those of us utilizing IRAs, whether they're traditional or Roth,
The IRA contribution limit rises to $7,500 in 2026, providing more room to shelter your savings. And for those aged 50 and up who are trying to aggressively catch up on retirement savings, the limits are even higher.
let's detail those catch-up limits because they can make a massive difference in the run-up to retirement.
They really can. For those 50 and older, the catch-up contribution for 401ks and similar plans increases to $8,000 in 2026. This means a potential total contribution limit of a whopping $32,500.
$32,500? That's a huge amount.
It is. And for IRAs, the catch-up contribution is seeing a cost-of-living adjustment, increasing to an extra $1,100. This gives eligible IRA contributors a total limit of $8,600.
We also saw adjustments to health savings accounts, HSAs, and flexible spending accounts, FSAs, which are fantastic for managing health expenses with pre-tax dollars.
Correct. The HSA limit rises to $4,400 for individuals and $8,750 for families. The FSA maximum contribution increases to $3,400 with a rollover limit of $680. All these numbers are highly relevant to Activity 5, the tax planning, and Activity 6, the portfolio review, because they determine where you should direct your new cash flow first. You should always maximize these tax shelters before moving to taxable brokerage accounts.
So the key message in this final pillar is not just to invest, but to invest efficiently. You need to be using the highest contribution limits and aligning your portfolio, especially your fixed income, with the sophisticated analysis that expects structural growth in the U.S. economy, driven by those fiscal policy beneficiaries and AI adopters.
That's the pro-level move for 2026.
If we connect all this to the bigger picture, these 6 steps have to become integrated habits. So let's look at 2 specific planning scenarios for 2026, where these fundamental steps meet that new macro reality of the U-shaped recovery and the new tax limits.
Let's do a case study. Consider Sarah, a single taxpayer who's really focused on maximizing her retirement savings. She participates in her workplace 401k plan, but she also wants to contribute to a traditional IRA to potentially claim a deduction. She's hitting Activities 5 and 6, tax planning and investments, simultaneously.
So her first move, based on the new 2026 limits, is adjusting her payroll. She knows that 401k limit is $24,500. She has to adjust her monthly deduction now, in January, to hit that amount smoothly by year end if she waited until July.
She'd have to scramble.
Yeah.
She'd have to really increase her deduction, which could potentially stress her immediate cash flow. But the IRA deduction adds a layer of complexity that requires that early planning. If you are covered by a workplace plan, your ability to deduct traditional IRA contributions is subject to income phase-outs. For Sarah, the single taxpayer, that phase-out range for 2026 is between $81,000 and $91,000 of modified adjusted gross income.
And why does knowing this income range now matter so much?
Because if Sarah projects her income for the year will be near or slightly above $91,000, she might determine that she won't be able to deduct the full $7,500 contribution. This realization can change her entire strategy immediately.
So what would she do instead?
Well, instead of contributing to a traditional IRA and losing the deduction benefit, she might instead focus on a non-deductible traditional IRA contribution followed by a Roth conversion. the so-called backdoor Roth strategy, assuming her income allows it. Or she might just decide to allocate that extra $7,500 into a taxable brokerage account that's focused on those institutional favorites we talked about, USAI adopters.
The key insight here is that the timing is everything. If she waits until December of 2026 to verify her income and her deductibility, she runs the risk of either missing out on maximizing her $24,500 401k limit or being forced into some hasty, suboptimal investment just to try and claim a deduction she might not even be eligible for. Proactive tax planning eliminates all that pressure.
It does. Now let's shift to the housing market. Consider, David, a prospective first-time homebuyer trying to navigate the 2026 market, which is balanced, but it requires serious financial discipline. This scenario integrates activities 1, PFS, 2, goal setting, and 4, risk planning.
And the 2026 forecast offers a little flicker of hope for David. The typical monthly payment for a median-priced home is expected to fall 1.3%. That's the first annual decline since 2020.
Oh.
That modest affordability improvement is welcome, but that average 30-year fixed rate is still 6.3%.
Success for David hinges on starting with activity 1, getting that crystal clear personal financial statement. He needs to know exactly what his debt-to-income ratio looks like before a lender tells him. If his PFS reveals high current liabilities, his first goal, activity 2, has to be debt reduction, not house hunting.
Okay, but assuming his PFS is healthy, activity 2 then focuses on setting a specific down payment goal. And the research suggests aiming close to that 20% down payment threshold is extremely beneficial for securing the best mortgage rates. And of course, avoiding private mortgage insurance, PMI.
Right. So his goal should be save $6, 20% of the target home price, by September 1st, 2026. But here's where activity 4, the protective shield, becomes absolutely essential. David must have his 3 to 6 month emergency fund completely separate from his down payment fund.
Why is that separation so crucial when you're buying a house? I think a lot of people just lump it all together.
They do, and it's a huge mistake. Because closing costs, moving expenses, and immediate repairs can easily deplete a poorly managed down payment. Furthermore, the type of home David targets affects his risk planning. If he's looking in the Northeast or the Midwest, where fixer-uppers are more common, he needs to budget extra cash for immediate renovations. And that money comes from the emergency fund or a dedicated renovation savings goal, not from the down payment.
And what if he's looking at new construction, say, in the South or the West, where builders are more active?
That's where planning for strategic leverage comes in. Builders are offering incentives like mortgage rate buydowns to move inventory. A financially prepared buyer like David with a strong PFS, a high credit score from working on Activity 3, and a separate emergency fund from Activity 4 is in a much, much stronger position to negotiate and leverage those incentives.
He won't be desperate.
He won't be desperate, and desperation costs you money in real estate. The takeaway is that 2026 is a balanced market where preparedness and strategic planning translate directly into a lower lifetime cost of home ownership.
So, what does this all mean for you listening right now? The great thing about these 6 activities is that they aren't conceptually difficult, but they do require immediate tactical action. Don't let this detailed knowledge just sit idle. Here are 4 steps you can take today, right now, in the spirit of building a strong financial foundation.
First, schedule your statement hour. This week, put it on your calendar. Dedicate 60 uninterrupted minutes to completing your personal financial statement. List every asset and every liability using those categories we discussed: current, investment, and fixed. This clarity is the single most powerful step you can take toward financial ownership and eliminating that financial fog.
Second, benchmark your goals and choose your debt weapon. Take your top 2 financial goals, for example, eliminating credit card A and maximizing your 401k. Assign a specific dollar amount and a rigid deadline. And if you have debt, decide today whether you will commit to the mathematically superior avalanche method or the behaviorally reinforcing snowball method, and then set up the automated payments immediately. Don't wait.
Third, audit your defenses and review your coverage. Immediately check your emergency fund coverage. Is it truly 3 to 6 months of your necessary expenses? Then pull out your insurance policies: health, life, property. Specifically, check your property insurance dwelling limit against the rising costs of construction and inflation. This ensures your shield is adequate for your current reality, not the reality of 5 years ago.
And fourth, maximize your tax shelter. If you participate in workplace retirement plans, log into your account and adjust your contribution rate now to ensure you are on track to hit the new 2026 limit of $24,500. Don't delay on this one because proactive contribution adjustments prevent those hasty suboptimal investments at the year's end and let you leverage those immediate tax benefits all year long.
So we dove deep into the 6 essential activities for steady financial movement in 2026. Establishing your current reality, setting clear, measurable goals, tackling high-leverage debt, building protective risk shields with cash and insurance, proactively planning your taxes, utilizing the new IRS limits, and reviewing your investments against a new economic backdrop that strongly favors U.S. growth and specific credit classes.
By taking these actions, by truly integrating them into your life and treating your personal finances like a corporation manages its own balance sheet, you ensure your financial momentum is positive. You make your finances better in 2026 and even better in the years that follow.
And critical thinking is just essential in a world of information overload. As institutional money managers favor U.S. industrial policy beneficiaries, AI adopters, and specific fixed income products like asset-backed securities in 2026, ask yourself this provocative question: how do your personal savings and investment choices benefit from the fundamental economic and legislative shifts taking place around the world?
Are you just keeping up?
Or are you strategically positioned for the specific targeted growth that's coming?
That's what we want you to mull over. If you found this deep dive valuable, we encourage you to share it with someone who needs a financial roadmap or subscribe for more analysis that cuts through the noise. We'll be back soon with another deep dive.